All right, I'd like to call the Board of Finance March 18th meeting to order at 6 o'clock. We stand for the Pledge of Allegiance. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, we got an action-packed agenda. First on the list, Vanessa Rosita from Bloom Shapiro. Vanessa. Yes, if you would, please. Ask Vanessa just to come in and go over briefly the audit report, management letter, and to touch on the agreed upon procedures. So
I'm just going to give a treetop level explanation of what we do and the results of the audit. So if you all have any questions, just interrupt me, all right? So we are your independent auditors. We produce your comprehensive annual financial report. This is management's report, but we just audit it. So management is really responsible for everything that is in it. You also should have seen a federal single audit and a state single audit because the town receives both federal and state grants. We're required to perform both of these audits in accordance with rules and regulations mandated by the feds and the state of Connecticut. If there are any suggestions for improvement on your internal controls, we'll issue a management letter, which we did this year. And we also perform agreed upon procedures on the Board of Education's EDO one. All right. So just to summarize, we have issued a clean opinion on the town of Simsbury's financial statements. A technical term this year, they've changed the terminology. Rather than saying unqualified, it's now called an unmodified opinion. So it basically means that everything is stated correctly in accordance with government accounting standards. Do you want me to go over any of the numbers in the CAFR, or that's already been done?
I don't know, does anyone, I have one question. Does anyone have any question on any of the numbers? I mean, it was a clean report, right?
It was a clean report, yeah, no, yeah.
So there's no, is there anything worth noting to us, the action taken? I mean, I had a comment on one of the footnotes you wrote about bear with me, there's stuff in here. At the end,
Was it the deficit fund balance?
yeah, deficit fund balance.
Okay, that's on page 37.
37, all right.
Yeah. So the Simsbury Farms, we're required to report which funds have a deficit fund balance. We're also required to report if any of the line items in the legally adopted budget were overspent. So those two items are noted on page 37. So the Simsbury Farm Fund does have a deficit fund balance of $234,950.
You so noted that the year before, too.
Yeah.
Well, I think it was a smaller one, but
Yeah.
so 234 is a deficit. Now, on the other amounts you have in there,
Yeah.
so we show we're overspent the sewer use. Is that what that is? Transfers out?
Yeah, transfers out both in the general fund and the sewer use fund were overspent.
So basically, we're not supposed to do this. So that's what it means. So that's why they so note it. So we have to, that's why I put it on one of our goals on Simsbury Farms to make that whole, because we don't want to have deficit spending, we have to make it right. What we should do in the future is we should transfer money before the year end to make the fund whole. And that's what we used to do, but somehow we didn't do it last year, so.
Right, and even in the two general fund and sewer use fund, it's really important to get up-to-date financial information from your finance department so you know where you stand budget to actual, so you can make transfers if needed.
How did it happen to sewer use fund?
While we're on the subject of Simsbury Farms, we have a new subcommittee that's sort of looking at some of this stuff. In your work with other towns, have you seen a lot of use of enterprise funds as opposed to doing special revenue funds? And do you have any thoughts, opinions, or?
I mean, I don't really have any opinions either way. It's just a different method of accounting for something. An enterprise fund really should be self-sustaining, like a business, right? And it also, if you do change a special revenue fund to an enterprise fund, you have to bring in all the capital assets into that fund.
That's required?
It's required, and you have to depreciate it. So now you have to charge a fee that's self-sustaining for the enterprise fund, but it's also going to have to sustain the depreciation expense too.
Do you see other municipalities that have enterprise funds, but out of the general fund, they are on a regular basis providing the monies that sustain them?
Yeah, I think even if it's not on a regular basis, sometimes they have to allocate a little bit more that year because maybe the activity wasn't that great. But I do have a couple clients that have a golf, I'm assuming the golf course is the main.
That's the one we've been talking about.
Yeah, I mean, that's what I see the most is the golf course as an enterprise fund.
And right now, we have the debt service in the town budget, capital non-recurring between both.
Okay,
Some in the
right.
town and some in the special revenue, it's kind of all over the place.
Right.
And then the operating expenses are there with an allocation of overhead to
Okay,
run it.
right.
So that's what's happening, and if we put it all together, I mean, get true cost, there's a lot of costs that they don't see, they would see if we went to enterprise fund.
That's right.
So I asked for the depreciation schedule, we'd put all those assets, but also they'd get a truer look at their operations.
Yep.
Now, is there an added cost for the audit if we have an
No,
enterprise fund?
absolutely not, no, nope.
Is it worth the bother of doing it?
That's up to you all. It's easier, just as easy for me to audit it, so it's really your decision. I don't want to sway you.
Thank you.
Okay.
I think we were
You're looking for the magic
sway,
answer, you're not going to get
Every
it.
once in a while, a
Sorry,
little
trying to
sway
be
is good.
PC up here.
Auditors are
Get
good
the-
at
get the
not
s-
giving you a
The
total.
silver bullet. Okay.
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 Um,
I mean, nothing's really changed since last year in the CAFR. There will be some new GASB pronouncements next year. GASB 65 needs to be implemented next year. What that is it's basically just a geography change on the balance sheet. So rather than having assets, liabilities, and net assets, now you're going to have assets, deferred outflows of resources, liabilities, deferred inflows of resources. So certain things are going to have to be reclassified. And then I know you all know about the new pension standards that are coming up, 67 and 68. So the new disclosures for GASB 67 are going to have to be implemented next year, too.
What year? 6/30/14?
14, that's correct. And I know
Suppose we want to do the other one, too. That's 6/30.
you could.
Okay.
Yep,
Is
absolutely.
anyone going to early adopt? Do you know of any town?
One of my clients is talking about it, but I think they're talking about it. They don't, I'm not sure if they want to be the first one to put that big number on the balance sheet, so.
Basically, what it is that unfunded liability in the footnote just shows up in your balance sheet. So I always push Simsbury to early adopt, because then you're out there and you understand it. The rating agencies, well, they'll talk about it, but they know it's there anyways. We're not hiding it from anyone, so you might as well put it out there, the number.
Well, our bond counsel, I'm assuming, is going to tell us that there are no surprises here, so, I don't see any issue with it, quite frankly.
But we'd have to tell the actuary to do it too, right? If we do
Right,
that, there's
yeah, and you have
coordination.
Milliman, so I'm not worried. They're definitely ahead of the game with 67 and 68.
When do we have to make that decision, do you think? To adopt if we want to go with it?
I mean, they have to do the calculation anyway for 6/30/14, so it's just a matter of putting the number on the balance sheet. So I would say you could make the decision this spring or summer.
And now it's sitting in a footnote.
It is, I'm not sure if, the calculation is probably going to be a little bit different. They might have to do a couple of different things with the way that they're amortizing the liability and the discount rate, and some other new disclosures.
I think they have to use fair value on the assets, not actuarial value.
Right.
So they use the real value, not their value. Okay.
All right. Any other questions on the CAFR? And I'll just
Nope.
speak briefly about the two single audits. Like I said, we did a federal single audit and a state single audit. For the federal single audit, we tested the special education cluster and the highway planning cluster. And for the state single audit, these are both on page 10, I think, of each respective, 10 and 11 of each respective report. We tested open choice, land acquisition grant program, and LoCIP for state. And we issued a clean opinion, both for the federal and the state, over compliance and over internal controls over compliance on all of these programs. So all good news there.
How much do we have in total?
In total, for the federal single audit, Simsbury spent $2.533 million. And then for the state, Simsbury spent a little over $10 million, $10,700.
Now, some of these grants are the ones that are outside the Board of Ed budget, they do a schedule on, and so so these are getting audited through this report, and they're for compliance and financial, so.
Right.
You go through a rotation in terms of your emphasis?
We abide by the rules that the state and the feds have issued, but they do, it's tough with Simsbury because a lot of times we're auditing the same programs because those are the biggest dollar programs. You don't tend to get very many new programs. So we tend to stick to the same ones. But when we can rotate them, we definitely do.
Vanessa, I'm going to ask you a question on
Yep.
compliance auditing. We've recently had an issue with our pension plan on a compliance issue,
Okay.
and I guess we weren't following a contract that we wrote, and it's been going on for a long time.
Okay.
Now, I'm not going to put words in your mouth, but that's a compliance audit. I know you do a financial audit on the
Right.
town,
Right.
and so as far as that, that's part of you do audit the financial aspects of the pension plan,
Right.
but you don't audit the compliance?
We do not.
Right.
We do not. So you're saying that the payout wasn't correct or something? I don't know what the issue is.
It's a withholding on people, what to pay
It's
in,
withholding, okay.
what
Yeah.
people pay in, so.
Yeah, and, I think this is an area that, you might want to look at as far as all of your withholdings of all your payroll. Is all of that correct? I mean, that's something that the towns really should check themselves on, because we can't audit every transaction. You don't want to pay us to do that.
Well, we had talked about a compliance audit. I know that the for-profit world has to get one once you have 100 employees,
Right,
but the municipal world does not.
that's right.
So I know we're going to be discussing that in the next few months. So
Right.
just want to make everyone understand what they are auditing and not auditing, and why we might ask for that if we do. Ask for a compliance audit. Because basically, with the pension area, it's very complicated, the compliance, the whole census report on what you do and don't do. There's a
Yeah.
lot going on there.
It's based upon birth date and all
Sure.
that, right. Yep.
Contracts, there's a
Yep.
host of stuff going on, so. All right.
All right.
Why don't you go through the management letter?
Sure. So there are 3 levels of an audit finding, if you will. The level that is in this management letter is just basically a suggestion for an internal control improvement. It doesn't mean that anything was significantly wrong with the financial statements or the way anything was recorded. The next level is a significant deficiency, which means that there's something deficient in your internal controls that had the audit not been performed, it wouldn't have been caught. And then the highest or worst level is a material weakness, which means that there's severe weaknesses in your controls, right? So if you had a significant deficiency or material weakness, it would have been required to be reported in the federal and state single audit. But these are merely suggestions for improvement. All right, so just to put it in context. So the current year recommendations, the first one is internal control. When we're required to obtain an understanding of your internal controls. While we were doing that, we noted that each individual in the town finance office has the ability to make journal entries, and those entries can be posted without review from a second individual for accuracy. So we're recommending that all journal entries be performed by one person, reviewed by another person, and that proper sign-off takes place. This is a pretty important area because the general ledger can be misstated via a journal entry very easily. So if nobody's approving these entries, there could be something significantly wrong.
But we're getting into a staffing-related issue here, right?
It could be staffing, it could be process, right?
Is it automated, or is it's not? Okay. Is it often, is the general ledger often automated? Is there software out there that?
Yes,
could
the
be
general
purchased?
ledger is automated, and what we're talking about is there's automated journal entries that are being made to the GL without being approved. So if your GL has the ability to automatically in the system approve a journal entry, that's the best way to do it.
So that there is a way then, hopefully based on the software that we currently have, that would necessitate that before the entry is,
Posted, it's approved,
Posted.
right, exactly.
it's approved by a higher level, somebody, password authority.
That's right, yeah.
Joe has his list of things to work on.
Yeah. Good.
All right, and then there was a couple items with the capital assets this year. So during testing of capital additions, it was noted that 2 items out of 12 tested did not have support for the cost used to enter the asset in the capital asset software. So a couple assets were entered into the software, there was no support for it. The town did purchase a capital asset software package, which is a step in the right direction. But during that implementation process, there were approximately 110,000 of older assets that were discovered in the current year during the implementation process that had never been added to the detail. There was also an additional $1 million of errors in construction in progress where assets had been previously capitalized but were never removed from construction in progress. So basically, the asset was in service, but it was just never reclassified from construction in progress to buildings or equipment or whatever the right category was. So we're recommending that the town implement policies and procedures to ensure proper documentation is maintained for all asset additions, and that there's proper review of capital assets at year-end to ensure all assets are included and classified appropriately.
Can you explain what construction in progress is, at least what that status means relative to depreciation and
Sure.
what have you?
So when you're constructing a building, it's not subject to depreciation because it's not in service yet.
Service,
So
right.
it's not classified as a building, it's classified as construction in progress. And a lot of times it could take 2 or 3 years to complete it, so it kind of hangs out in the construction in progress category. When it's in service, it gets reclassified to buildings and starts getting depreciated. So I'm not, and I do find in my clients that this is an area where there is errors a lot of times because they never go back to construction in progress to make sure that everything that's in there should still be there and shouldn't be capitalized. So I don't know what, if the system has a construction in progress category, that would be the easiest thing.
Vanessa, isn't the problem really that on many projects, it's not very clear-cut when you go from, I tend to think of when a CO is granted on a new building, it's pretty clear that there are going to be people in there now and the thing is sort of finished. But,
Right.
Our high school project,
Yeah.
we had a couple of, a year and a half or so worth of construction and about 5 years worth of punch list items
Yeah.
and lawsuits and all sorts of issues about.
Right.
And so it isn't always necessarily clear when you start.
Right, but I guess in that case, I would say that if the students are in the high school and utilizing the space, I would say it's probably in service, and you just have to figure out what to do with those lingering costs, yeah.
So the $1 million here was being capitalized, So it didn't result in the accounting error, but it wasn't removed from the,
It wasn't classified appropriately,
Wasn't-
and it
exactly.
wasn't being depreciated, it should have
was
been.
not being depreciated.
Right, right,
So would
because
that
it was
have-
still in, it was still in construction progress, right.
So what impact does that have on the balance sheet?
Well, we,
understood expenses.
we,
It's just a classification. You call it one thing, and you should put it to another category and start depreciating it.
Okay.
But it doesn't actually result in a cost to taxpayers.
No, it doesn't.
It's a-
no,
it's a-
that's right.
yeah.
That's
10 years
I just
ago,
wanna be
we
clear
didn't,
about
10
that.
years ago, we didn't put these assets on the
Right,
books.
right.
Right,
Okay. So it's not like it would alter our financial position?
No, it's not going to alter, that's why it's in, it's not a,
It's not material?
Not
No,
material.
It's not material.
Got it, okay,
it's just,
yeah.
well, and the depreciation is recorded in the financial statements that are the full accrual GASB 34 financial statements that don't have any impact on, the mill rate or anything. It's kind of just the full accrual for the GASB to be happy.
but I assume the rating agencies are looking at, when you look at our net worth, it goes to our net worth. And when we
Right,
put this
right.
other liability on the book, we're going to start focusing on net worth a little bit more than we have.
I don't know how much rating agencies are looking at that, unfortunately, so.
And we chose a policy on how we depreciate our assets way back when we put it in. So the board, it's one of our policies we have on what life we take for assets. So it's something we might want to revisit throughout the year, but it's, we put roads on for certain life buildings, and, our board adopted a policy when that GASB first came in. So
All right, the next couple items we've made in the prior year, so we're just kind of reporting on the status of them. So the first item is the general ledger maintenance. So one of management's responsibilities is, as I stated before, is to ensure that the financial statements are fairly presented in accordance with generally accepted accounting principles. So this year, or during the prior year, entries were made to claims incurred but not reported and accounts payable balances in the internal service fund. So last year, we recommended that the town implement review procedures at the end of the year to identify any issues prior to the audit. The claims incurred but not reported should be recorded, and claims should be reconciled to vendor confirmations prior to audit fieldwork. So during this year's audit, it was noted that these entries still needed to be made as adjustments, and the town didn't implement this recommendation.
another item for your list.
I mean, is this just as simple as booking the IBNR at the end of the year?
Yeah, and reconcile, and making sure that the other balances are
The other
reasonable.
balances just-
We're talking about our health
That's right.
program only, or is there anything else?
This was mainly the internal service fund. I don't know if it's all three funds, I'd have to look back, but it could have been, yeah.
And why isn't the ASO taking responsibility for that? I mean, if it's health claims, is that what you're talking, you said it's health?
I don't know what ASO is, I'm sorry.
Our administrative.
Administrative services.
They're not running our books.
This would be my,
Yeah.
Workers' comp?
So they've reported it to us, and we haven't put it on our books. Okay.
That's correct, right,
typically,
right.
you won't kick off the auditors until you've already recorded your IBNR.
Yeah.
There's always going to be some adjustments that happen, but IBNR is pretty straightforward.
Yeah, yeah.
And they
that
send
should
an accounting of
come-
claims and
Yeah.
all that, and the general ledger should be reconciled to that.
Okay,
and
so
it
somebody just didn't put it in.
Right.
Yeah.
But it's also subject to judgment, too. I mean, as to,
Well, they calculate the IBNR,
Yeah,
right?
It's pretty predictable.
So the town needs to record that estimate, if you will.
yeah.
yeah.
So it just wasn't recorded. Right. All right. The next item is the accounting procedures manual. This is 2 audits ago, it was noted that the town's finance office and the Board of Education's finance office did not have an accounting procedures manual. So we recommended that both the town and the Board of Education consider the development of such a manual, et cetera. So 2013, the town and Board of Education are in the process of creating this manual.
And they're creating hopefully one manual that applies.
It could be, they're probably different, one for the Board of Education and one for the town, because they're on different systems.
The point is, we have to get one. So we have
Yeah.
to,
I'd rather get one than two.
Well, but sometimes that's not always possible if they're on two different
Right.
systems. There's two different ways of doing
Yeah,
it.
to the degree possible,
Right.
let's not reinvent the wheel twice.
Is the content dictated largely by the software systems and what have you being used?
It could be a little bit, but it's also about how to record things according to government auditing or accounting standards, just kind of a roadmap, how often to reconcile an account, who should be reviewing it, just kind of a nice guidebook
Right.
to have, so if there is turnover, what have you, there's kind of a roadmap of what to do on a weekly, monthly, annual basis.
Most of which should be pretty similar, even
Well,
if it is
yeah,
two different
I remember
ones.
this came up right, I think after I joined the board, and my recollection was saying, gee, isn't it rather than create from whole cloth, isn't there something out there already, other municipalities that would have this, that could simply be adapted? I think the response was yes, and we're working on it.
We just got, it's here and still in front of us, so we just got to make sure it happens.
Happens, yeah.
So just good policy,
Here's our new guy.
best practices, and make sure it happens, so. Okay, Vanessa, why don't you move on?
Okay, and the last item is the positive pay.
Positive pay.
I know you all have probably talked about this. So I know the town has tried to do this, the bank has been trying to do this, and I think you're still, as the date of this letter, you're still working with the bank. So you probably know more than I what the status of this is.
We don't have done it, did we yet? Okay.
I do have something to come back and forth.
Positive pay, why don't you explain what positive pay is, so just. for new
Positive
members.
pay is, the bank gets a listing, the bank needs to reconcile the checks that they have from the town for payment. So they reconcile the payee and the amount. So basically, no check can be altered after it leaves this building because they reconcile to make sure that you're paying Susie Smith $100. So it's a very good fraud control vehicle.
But just to clarify, you didn't actually find any instances of actual fraud?
That's correct. That's right. We weren't looking for it because
Right.
that's not part of the audit, but we did not find any. That's right. Yep.
Or whether fraud has been found, this is it's a common way of committing fraud.
Absolutely,
Is that-
yeah.
So
Good
positive
prevention.
pay eliminates that, or
Yeah.
the chance of that.
And it
So
gives-
it's worth looking at.
Yep. Yeah, and there is a cost associated with
Yeah.
it, but, cost benefit. Right. All right.
All right.
So that's all the management letter. We also did an agreed-upon procedures engagement at the request of the Board of Finance. We looked at a couple different areas, student activities, Simsbury Farms, Performing Arts Center, and building permits. We've issued a pretty lengthy draft report with some recommendations. I believe management is going through it with the parties involved, the departments, just to make sure that that we understood everything right, the process is right, and if they have any questions about our recommendations.
They haven't final issued this.
No.
This will be,
No, this is-
so it's just for our information now that it's in process.
Right.
We'll get a final report with responses, so again, it'll be another action list for Joe. Well, thank you.
Okay,
Appreciate it.
okay,
Vanessa.
great. Thank you.
Any other questions, everyone? Thank you very much.
Okay,
Thank
Appreciate
you.
your time.
Thanks.
All right, next on the agenda, we asked Public Financial Management to come in, Bill Fazzoli to come in from them to speak to us about what's new in the bond world and rating world and how we're viewed, and kind of go through a few of our policies so we can just, get into why we do what we do and why we should think about maybe changing if we're going to change.
Sure. Good evening. Again, my name's Bill Fazioli. I'm with a firm called Public Financial Management. We're the nation's largest financial advisory firm in the country. I'm based out of Providence in Boston. I work with communities throughout New England including Connecticut, New Hampshire, Massachusetts, Vermont, except Maine. We haven't got up to Maine yet. So I think that's a valuable perspective that we can give clients, that we can see how other communities deal with similar issues that Simsbury has. So for tonight's presentation, I had a series of things that I was going to go over, and you can tell me which ones you want to include or not. But I wanted to give a very brief overview of the town's most recent bond rating that was assigned last February, about a year ago. We did an analysis of AAA-rated communities in Connecticut about a year ago that we provided the town that compares some key credit ratios of Simsbury versus other AAA-rated communities in the state that kind of give you a perspective where you are relative to those other communities. I also wanted to discuss a little bit about what's happened in the rating world since this report was published about a year ago. There's been some changes at Moody's at the way that they've conducted their rating evaluations that have gone into effect middle of last year and also most recently the beginning of this year. And then I have a listing of other ratings for every municipality in the state of Connecticut as well that I can leave you. And I also have some draft financial fund balance policies that I can leave with the finance director and Mr. Kimball as far as if that's something that the town is looking to develop. So just quickly, and again, not going through the slides, but just to confirm what the current rating is of the town, your AAA rated, that was last affirmed last February. That's obviously the highest municipal bond rating there is. According to the report, the rating rationale was based on the town's history of sound financial management, stable tax base, strong wealth indices, and manageable debt burden. The credit strengths were conservative financial management practices, which have resulted in a history of positive operating results, stable reserve position.
What does positive operating results mean?
That's a surplus. Every year, your revenues exceed your expenditures.
Okay.
So, stable reserves and a stable tax base with, again, above average wealth levels. The challenges that Moody's identified in the report, and the report, again, didn't change the rating or didn't change the outlook on the rating. The rating is considered stable, was slow revenue growth in the grand list, which is common, coming out of the recession, and some liabilities in the pension and OPEB funds that are on the books, but I know you're addressing and you're meeting your annual required contributions, but still there are some shortfalls in terms of those funding levels. So that's the most recent rating that was affirmed last year about this time. And again, I provided a copy of that to the finance director and to Mr. Kimball, and so if that's available, so it gets into a little bit more detail. So.
And how often do they review that?
It's largely every time you issue debt. This was done in connection with the bond issue, but they do reserve the right to review you in between offerings. So upon the publication of the audit that was just talked about tonight, they do reserve the right to call you and do a surveillance call is what they would say, to review the most recent financial results. Or if they see a trend that's disturbing, they will want to follow up on that. So that's really the rating in a nutshell. The next piece is just sort of a very quick overview of the report again that we provided, and I think you have handouts here. So if you want to just go, Sean, right to the rating scale. Again, this is something you all know. There are three major rating agencies in the country. They use different ways to highlight what their ratings are. Some use capital letters, some use small letters. But right now, you're with Moody's. That's your rating. That by far is the most predominant rating agency, probably in the industry. Standard & Poor's is fairly close, and not as many communities use Fitch. So obviously, AAA is the highest you can go, and you can go all the way down to that red line denotes what they call below investment grade or junk bond status. And there are some communities, not necessarily in Connecticut, but around the country that are in that single B and even C category.
We had been AA1 until a few years ago. We got AAA.
Right. Yeah, so that's obviously you really do join quite an elite group. And the next slide talks about a little bit about, if you could just hit the, what the rating factors are. Again, this was based on the methodology that Moody's had in place last year. It's changed a little bit. This is sort of the rating factors and the weighting that they assign for each one. Economic strength of the community is the major one under this methodology. Financial strength, management and governments, and debt profile. Again, a year ago, Moody's had a very negative outlook on local governments in terms of their credit outlook. That has since been removed. It's now a stable outlook. But a year ago, they felt that communities were still struggling coming to terms with the recession that took place in '08. But starting in 14, they've given it a stable outlook and have removed the negative outlook. There is a very strong reluctance to move a community to a AAA rating. In fact, in the last few years, I think there's only been one community that I've worked with that's gone to a AAA rating in this economic environment. It's a suburb community outside of Manchester, New Hampshire called Bedford. It's a very wealthy community. It's doing very well economically as well. So it's very, very difficult to get to the AAA rating, and Moody's has always made it very, they don't take the move into AAA very lightly. So. Again, nationally, this just sort of gives you the rating distribution for all local governments based on the Moody's data. The average rating is in the AA category, and again, very select group are in the AAA, and that's designated by city, county, and school districts. And you can see just by the rating distribution, it's mostly in the AA category, AA2, and very few in the AAA. So you really are an elite group. In fact, based on the data, I'm sorry.
But our school district is part of
you're
our
part of
town,
your
so-
town,
okay.
yeah, right, yeah, so.
It's
Again,
whatever.
and from a percentage point of view, only 4% of the ratings in state and local government sector by Moody's carry a AAA rating with a stable outlook. So again, you're in the top, 96th percentile of that distribution. The characteristics of a AAA rating community are economic stability, financial stability, low to moderate debt, and strong management. Last year, Moody's did put a number of AAA communities on negative outlook because of their connection with the federal government, because of potential cuts from sequestration and potential reductions in spending for defense and research and that nature. So there were some communities that were put on negative outlook, but I don't believe any of them were actually downgraded because of those federal impacts.
Is the difficulty that we had perhaps in moving from AA up to AAA because of the revenue diversity?
Yeah, that
issue?
might have been part of it. But you obviously have overcome that in the last few years, and based on the performance of the town's reserves, and again, very moderate debt position and performance of the economic factors, you were able to get into the AAA rating.
But I guess I was referring to as our dependence on the single-family home.
Yeah, no, residential property tax, again, it works for you and against you. It's a very stable form of revenue, but obviously it places the burden on families as opposed to a commercial sector. The next series of slides, this sort of compares Simsbury, as we represent by the orange bar, based on some key rating ratios that Moody's again calculates that our firm is able to subscribe and pull this data. And this data is as of fiscal 12. The fiscal 13 data won't be available till about middle of April. So we'll certainly update the slide for you in this presentation to see how the most recent audit results reflect and how you compare. And again, it compares Simsbury versus all the other Moody's AAA rated communities in the state as of last year. And we derive a median. And the median in this case is the AAA median for all of the Connecticut AAA medians. So we sort of just made this a very Connecticut-specific analysis.
What is that median? About
Minus? Yeah.
11.75?
I can tell you exactly what it is because I had the printout here.
Looks like that.
And I have my glasses, which is even more
Look at
important.
Greenwich.
The unassigned fund balance is 11.7%, so.
And can you define that, please?
Yeah, unassigned fund balance is, I brought the glossary, so.
Oh, just reserves, okay.
Yeah, it's basically, it's
Unassigned.
your undesignated, unencumbered fund
And
balance.
at this time, ours was 10%. We've gone, a year or so beyond that, so we're
Up
up.
closer to 12 now.
Yeah, we're up.
Yeah, so again, this is fiscal 12. This compares Simsbury with, again, the AAA communities in the state. And you can see some are in the, high, as high as 14% and so on, and some are as low as Greenwich, less than 2%. Greenwich is able to overcome this because of other very strong factors that they have in their case, which we can highlight.
They
So-
can panhandle and raise whatever they need.
They have loose change in there that's probably,
We're
so-
going to talk about what's adequate. I mean,
Yeah, we
We're
will.
going to set a range, so.
Right. Yeah, but again, Simsbury at 10% is certainly respectable relative to where the town is. It's slightly below the median in the state, but I think in fiscal 13, you probably surpassed it once we do the analysis.
Do most towns have I guess I'm going to call it a guideline as opposed to a policy as to where they want to be at?
Yeah, most of them have a guideline. It's sort of an unwritten rule that they adhere to.
Can you share that with us?
Yeah, more and more communities are adopting formal fiscal policies where it's written down and it's approved at either an elected official level or a board level. And I have a sample of one that I can provide you, but there's also an outfit called the Government Finance Officers Association that sort of sets best practices for communities, and I have that policy, and I can share it with you as well. They generally would like to see a fund balance. They don't state it in percentage levels. They say you should have at least 2 months operating cash on hand, free cash as a percent of your budget. So whatever that equates to here in Simsbury, that number could be different. But the percentage for AAA communities, probably a good benchmark is about 15%, 12 to 15%. That's just, again, nothing scientific. That's just sort of based on my experience.
If we did something like 10 to 12, are we going to get ourselves in trouble?
No, not at all.
Because we're AAA at 10 or a little below.
Yeah, I don't think so. No, I think that, if the thing that's going to, the pitfall is that if you establish a goal and you consistently fall short of it, then that's the problem. But if you say it's 10 or it's 12, and then you stick to that, then that's...
Well, the range is probably better, because
right.
then we're not...
Oh, yeah, no, most communities I know have a range. I've seen from 8 to 15. I've seen from 15 to 20. It's really a local decision. I have some clients in New Hampshire that have a 30% fund balance, because that's just what they're comfortable with.
They like to overtax their residents.
I don't know why they do it. That's what they have.
Okay,
So I don't want to make any editorial comments. But that's just the reality of it all. So, but again, this gives you where you are relative to your peers in Connecticut.
Can I ask a question? I may have misheard you. I thought I heard you say that there's a guideline that you should have 2% of operating cash on
2
hand.
months worth of cash.
I was going to say, how do you get
Yeah.
from 2%
2 months is
to
1/6, so what's that,
2
15,
months.
16,
I knew I must have
17%?
misheard that.
Yeah,
I-
so
that's
your
a-
revenues
that's a
are
bit
what?
aggressive,
Yeah,
yeah.
so that's sort of the GFOA standard. That's sort of the best practice. That's, eating 4 square meals a day and exercising an hour. I mean,
Well, we can still have the cash available, but
Right.
not necessarily undesignated
Exactly.
balance. There's many
Yeah.
ways to meet that
Right.
requirement.
Right, and again, these are just, and the policy, when you read it, there's a million exceptions to the rule, because they carve out a lot of nuances to reflect how local communities want to govern themselves. I mean, no one's saying you have to have this. This is just sort of the policy recommendation, So we all see our doctor once a year, and we get the recommendations to do, but some of us waver every once in a while, right? So from certain things. So, but at the end of the day, you go back, and next year, if you still got a pulse, you're good, right? So again, this gives you the sort of the comparative analysis just on that one factor, unassigned fund balance.
So we've obviously had discussions on what it should be and whether
Right.
it's too high and, do we have the right practices? There's some significant towns, I just point out West Hartford, Ridgefield, obviously Greenwich, but Fairfield too. And then there's a lot of towns, Avon, are bordering towns at 8%.
Right.
And the first groupings were way under 8.
Right.
And yet they still say at a AAA.
Yes. I mean, there are other factors, there's, and again, I'm going to go through some of the other factors. It's not just all about fund balance. It's your annual, budget performance, your tax base, your local economy, the amount of debt you have outstanding, how fast you pay it off. So just by having a high score in any one category, it's not going to necessarily guarantee or default you to a certain rating category. But, this type of information allows you to have that discussion and say, where do we fit in?
So I'll ask a really silly question. Is there a high AAA and a low AAA? So I mean,
No.
when you look at these towns, I mean, I know there's really just one
Yeah.
out there, but when you look at these towns and there's multiple factors that are taken into account, we're trying to understand, which ones are at risk for us, and if we were to move one of them, could it impact
Yeah,
us?
I think if you read the Moody's report that I just cited, they never mention that there's a threat to the town in terms of reserves. They mention the threat is the OPEB and pension liabilities and the sort of weak, tax-based performance. If they said, they would clearly say in their report, we think the town's reserves are too low relative to other AAA credits. They would clearly state that in their
If we
report.
took our reserves down to 8%, next time they came in, they'd probably put
Yeah.
that on there.
Yeah, because what they do is when they do a rating, they compare you to other comparable ratings to see where you stack up. And based on this analysis, you're, kind of right out where the median is. So you're at slightly over 10. The median last year was 11.7. So there's not a big
So
variance.
11.7 is fiscal 13?
Fiscal 12. This, again, this information through fiscal 12.
So this graph averages out to 11.75?
Yes.
Average or median? You said
Median. Sorry,
Because
median.
it sure
Yeah, it's a
looks
median.
like there's more than 50% below
Yeah, it's median.
11.5.
It's the median, and again, some of them might pull it up higher, like a Darien or a Wilton or a
Yeah, but
Woodbridge.
median is
Based on the total.
50% above and
Right.
50% below.
Right.
I mean, you can see there's a lot.
And yeah, and if I put the national chart here, the national median, you'll see it in the 20% range. New England communities traditionally have lower fund balances than other communities out west. But again, the more conservative tax base here, voter. So, there's not a high tolerance for 30% fund balances here in New England. So I can continue on.
Yeah, why don't you move
so,
through some of the-
again, there's a lot, again, the idea is not to debate what the number is, but to give you the information to have these discussions. This is an interesting slide. I know it was probably going to add for some commentary, but this is, again, another measure Moody's uses net cash as a percent of general revenues. It's simply what you have cash on hand less any short-term operating loans or accounts payable, things of that nature. Last year, Simsbury was markedly lower than the median based on, I think, some one-time factors. Talking to the
Sure.
finance director, there was a FEMA grant that money was outlaid for, and then they had to wait for the reimbursement. That didn't occur until after June 30th of 2012. Since then, and when we did the calculation for fiscal 13, your net cash as a percent of general revenues is 14%. So that's it's going up from last year, which was right around 8% to about 14%. Again, this is just, the raw data that Moody's, pulls when they do their reports. And there's literally 30 or 40 variables. I'm just highlighting some of the more significant ones. The next series of slides get into the debt factors, which Simsbury does very well in. This is debt as a percent of the full value, and basically that's the market value, the estimated market value of the, not the assessed value, but the market value of the properties in town here. Generally, when you're under 3% debt as a
Excuse
percent.
me, market value of all properties in
Yes,
town?
commercial.
Not just the government?
Yeah, everything, yeah.
Talking about our gross grand list.
Yes, exactly, yeah.
Not the net. grand
What they call it, the effective net grand list, being the equalized values, that I guess some state body establishes for you, that or your assessor uses some ratio of assessment to come up with an equalized value. So, again, generally you want to be under 3% debt as a percent of your full value. You're slightly above the median, but certainly, well below any type of trigger as far as debt as a percent of your tax base. This is an important factor because this is what supports debt service is property tax receipts. So this is why Moody's looks at this. The next slide gets into debt service as a percent of your operating budget. I know the town has a very strict policy here where debt service cannot exceed 7%. Or that's a guideline or a goal or
Guideline.
it's an idea. It's a guideline that, so you're, again, well below the median for the Connecticut peers, and also you can see some communities have substantial debt service as a percent of their operating budget. so-
Starford's really 20%.
Yeah. Again, we're not doing the calculations. We're pulling the data from the Moody's, data that they put into their system. So the next slide gets into how fast you pay out your debt within 10 years. Again, Moody's likes to see 65% as a good benchmark of what you're paying out your debt. But in your case,
Or paying
Simsbury.
off?
Hmm?
Sorry, just
Six-
paying off.
yeah,
Couldn't
pay
be-
off.
In 10 years.
Yeah, amortization rate, a retirement rate. So you're at 100% within 10 years. You pay off all of your debt, assuming you don't issue any more debt. Within 10 years, you pay off all of your debt.
Well, when we issued that high school bond, we weren't
It's
that good, because we did 15-year bonds, but we
Right.
haven't done a 15-year bond in 10 or 12 years.
Right. Last year's issue was a 10-year bond.
Okay.
Yeah.
So, again, relative to the median, you perform much favorably to that, and you can see where you stack up with the other communities.
But still interesting, it looks like the vast majority of the debt from other municipalities is also paid off in 10 years.
Yeah, I mean, that's a characteristic of a AAA rated community,
Yeah.
where they would have an
That's right,
aggressive.
these are all AAA.
Yeah,
Right.
it's an aggressive amortization schedule, so.
This doesn't include those towns that are doing capital but paying cash for them.
No, this is just bonded debt.
Yeah.
Right, there is, right now, I don't think there is a ratio that measures,
Yeah.
We don't have our water fund in here.
no,
We
this
have a-
is,
We have a longer-term loan
yeah,
on the sewer plant, but that's not.
this is tax-supported debt. This is debt paid by taxes and not necessarily by user fees. This is tax-supported debt.
This doesn't include the 2% loan to the state?
Is it
No.
really 20?
What was that, 25 years?
The sewer plant? Something like that.
Something like that. We thought 2% money was pretty good then, didn't we?
Last year, your 10-year loan was 1.29%, so just to show you where you are relative to, and that was a very favorable rate. Again, some of the other slides get into some more of the socioeconomic indicators. Sean, if you want to flip to the next. This is just the full value per capita. This is, again, the grand list at the market value divided by the number of people who live in town. You can see some communities like Greenwich probably have the highest score I think I've seen in the country. That's per person, so that may be why they don't need such a large fund balance.
And it's the number of residents, not
Yeah.
the number of households.
Number of per capita,
Including
yes.
kids.
Sort of questions why they even go into debt.
I don't think they have any debt in Greenwich.
Apparently they have been issuing bonds lately.
Really?
Yeah,
Yeah.
yeah.
The last time we bid on it, they didn't have debt, right?
The next slide gets into the median family income. This is a little old. This is based on the 2000 census. Obviously, it's stale. The census apparently doesn't produce this number anymore, median family income. There's a new source called the American Community Survey that does it every 2 years. And then for the next presentation, we can certainly update it, but this is the median family income as a percent of the U.S. income. And obviously, most of these communities who are AAA rated would obviously have median family incomes well above the U.S. median. And again, this is the actual raw number, the actual median family income. Again, according to I guess we did update it, according to the American Community Survey in 2011, Simsbury's at probably about 145,000 above the median. But, you can see some communities are more income rich versus land rich. So that's sort of a very quick analysis of where you stack up relative to other AAA peers, which I think is a helpful tool to have. And you can make policy decisions based on some of this information. And again, I won't get into this. You can read it. This is sort of the characteristics of a AAA rated community as far as how we pulled in a report that Fitch Ratings did, and they, and it really does relate to other rating agencies of some of the things they look for in a AAA rating.
And I'd be correct if AAA-rated towns, at least for the last couple of years, they've saved about, 4 to 5 basis points over AA?
AAA to AA, it's probably like 20, 25 basis points.
That
And if you
much?
were AA, yeah, it's really,
So that's-
compared to an A category, it's 100 basis points, easily.
I thought over the last couple of years, it was virtually no different.
No, the credit spreads have been, at least in the municipal
They're wide
world,
now?
yeah, they've been pretty wide. Yeah, there's been a real demarcation in the credit spreads in the municipal world, largely because there's no bond insurance anymore. That, everyone used to buy the insurance and you become AAA, but that market is evaporated.
So you said it's 25 basis points?
Oh,
or
easily,
100?
yeah, between AA and AAA, and then between AAA and single A, it's probably 100 basis points.
That's-
So.
It's about a quarter percent, you said, right?
So that's sort of the analysis. I just wanted to talk a little bit, again, since this report is done, Moody's has changed its methodology. We've prepared a report that we'll be happy to share with the new finance director. Made two real changes. One is that they've increased the weighting factor of debt from 10% to 20%, and they've dropped the value of the economic score from 40% to 30%. And they've come up with almost like a scorecard that you input data points, and it comes up with a composite rating score based on these factors that we can put into you. That new methodology went into place in January. There haven't been wide rating changes because of that new methodology, but clearly there's more emphasis on debt and pensions and OPEB, and less weighting on the tax base. So the town hasn't been reviewed under that methodology since it just was instituted in January.
That is good for us, yeah.
And the second large change that Moody's made is that they are going to do their own calculations of the town's pension liability. I know every year you do an actuarial report, you adopt a certain set of assumptions. Moody's thinks that's wonderful. They've come up with their own set of assumptions and their own analysis to improve the comparability of the pension liability at communities around the country. Because as you can imagine, some communities might use a 7% discount rate, some might use 8%. They said, we're just going to use 5 for everybody. We're going to use the market value of assets. They use their own actuarial tables, demographic tables, and they come up with a new number called the adjusted net pension liability, which is a number that they've started publishing late last year. It shows up in your credit report. It never shows up in your financial reports, your audit, never shows up in your actuarial report, but it's a new number that they say what they think your true pension liability is based on their methodology. So
Next time we go to bond, that will be.
Yeah, that'll be in there.
that way.
So,
Great.
They're using a 5% discount?
yeah, they use what they call a corporate bond equivalent,
Wow.
so.
I just had one question. We go back to the Moody's opinion that they issued, the last one you were citing
Yeah.
at the beginning of this. The two big things were funding pension liabilities.
Right.
And then our tax base, our weak tax base.
Right.
Being primarily residential and small commercial.
Well, they said slow revenue growth and grand list growth. So, I mean, they don't really hold it against you that your tax base might be skewed one way or the other. I mean, if it's performing and generating a levy that can support the town, how it's classified is not,
So
that-
it's the rate of growth, not
Yeah.
how it's classified.
right, yeah. So, I mean, obviously, housing values have stumbled and are starting to recover in some places, and that hopefully has helped your assessed values.
But that will be less important with the new
Yeah.
Moody's ratings.
Right, yeah.
And
So,
we're doing something about the pensions. So
Yes.
it should be good for us.
right.
We'll see.
Right. So that's sort of a lot of information, a lot of statistics. Again, I can leave you a sample debt fund balance policy and the sort of the GFOA best practice with you.
So Peter, your comment, we'll see. When will we be able to see what the new calculation does for Simsbury?
Well, when we decide to go to bond, I mean, right now we have about 3.5 million that we've authorized. I don't know if we've spent it all, but we're probably not going to go to bond until January
Yeah.
of 15. And we've always kind of used a magic number of 5 million. So if we approve more capital, depends on what the capital request is. So let's say we go for 5 million January, then we'll get it. We're not,
That's when Moody's will actually give us their opinion.
Yes.
But in advance of that, wouldn't it be possible to use their new calculation and find out where Simsbury would come out?
Yeah, we have actually replicated their database and can come up with an indicative score based on your fiscal 13 audit results. So we can certainly do that for you and see where you shake out.
Wouldn't you want to?
What do you want to
Yeah,
use?
I mean, and again, it's unofficial, it's not a guarantee. I'll give you an example. We did it recently for a community that was AAA rated, and when we put in the new numbers into the new scorecard, they didn't come out as AAA. Since then, Moody's has affirmed the AAA. So, you take it for what it's worth. Again, they haven't said there's going to be wholesale changes because of the new methodology, but the community that we were working with was a AAA. Based on the new methodology, they really came out as a AA2, based on the numbers that we crunched, but Moody's kept the rating at AAA. So it's hard I don't want it to be meant as a conclusive statement.
just give us a
Right.
concept.
Right.
I mean, when they come in and do the rating, it is what it is. We're not, it's all over but the
Yeah,
challenge.
and again, I just want to make sure that you understand, this is data just for the Moody's AAA rated communities. Standard & Poor's, which is the other rating agency, changed their methodology in the fall of 2013. It has led to a massive amount of upgrades and a number of AAA rated communities, within the last, all of a sudden, under the new methodology. Then they were maybe AA, now they're AAA. So I've seen that happen at least almost a dozen times in New England in the last 6 months. But this is just Moody's.
And split ratings are common.
Very common now.
Any other questions? Well, thank you very much.
Well,
We
thank
really
you.
appreciate
Sure. Appreciate your time.
the information, and hopefully the new update will show us beyond AAA, right?
So maybe we should pay somebody else. Maybe we should switch rating agencies if we don't like the result.
All right, Finance Director's report. If we could get a quick update.
Very quick, but yeah, I try not to cry. I will, possibly. Just a quick update on tax collections. If you'll recall at the last meeting, I said our January was slightly off where we were the prior year, leaving us about 0.69 percentage points off where we were the prior year, a year when we ended up at 99.6. I said last time we'd need to collect about $1.5 million in February to be back on track. We collected just under 1.4, so that's good news that it closes that gap a little bit. So now we were about 0.19 percentage points off where we were this time
What are we at, Sean?
last year. So now we're at 98.59% through February 28th, that would be. Again, we were 98.78 at that time last year. So, obviously things start to taper off here as we approach 99.5 or so. My best guess and estimate, and talking with Joe a little bit, is that we're going to hopefully end up around 99.5, so maybe just slightly off last year. Last year was really the highest we've had in a number of years. 99.6 was a very solid collection rate. So I think we're on track to be just shy of that, but we'll continue to update the board. I just included a few things that you actually already have. I know we just had a meeting last week, so some of this is just a recap. The estimated reserve transfers, that hasn't changed from what I handed out a few days ago, but just so people could see it again and keep thinking about the estimated year-end transfers we talked about on Wednesday. Again, just a calendar of where we are. On Tuesday, we'll be having the 25th Board of
Can we go back to
Selectmen.
the transfers? I mean, on here you have 550, but we're probably going to do Simsbury Farms if there's a deficit this year.
Right.
So we could have another 100,000 for Simsbury Farms.
Right, and we're still working, and Joe and I talked about that today, and we're hopefully have an update on where we think they're going to be in fiscal 14 soon. It's obviously a tough time of the year. They haven't ramped up, and they get a lot of their revenue here in the spring, especially with season passes and those things. So as we start to get those numbers and talk to Jerry about where we think 14 is going to end up, obviously we'll know that before the transfers, but that's something to keep our eye on for sure.
Something we'll do in June?
Yeah, something we'll do, right,
Yeah, makes sense.
at the end of the year, but just for your information,
Yeah.
because we can authorize up to 1% or 900,000. So we're getting there, we're two-thirds of it. So I just want to keep everyone's eye on the ball, that's all.
Right. On the calendar, just it's the same calendar, proposed calendar really that we've been working with in the prior director's reports. You'll notice on Tuesday, the 25th, coming up next week, the Board of Selectmen will present the budget and capital to the Board of Finance. Obviously, that's what we've been working on.
Is there a way to get that, something sooner for the weekend? Even though I know they're not going to approve it, is there a way we can get some preview?
Yeah, I'm going to talk tomorrow and try to figure out if I can get just sort of a draft of where they are at the last meeting.
So we have the
Obviously, there's some
weekend to
things
look
moving.
at it, yeah.
Right, and because I think most of the changes will be around the edges, so that way you could see the fun.
I don't know where they are in capital.
Mike's here.
Is there,
No comment.
okay,
We haven't finalized that.
Yeah.
Yeah.
We've got some preliminary numbers, but
they're still very, very preliminary.
Right, we're not going to hold you to it, we just want it just in our minds so we can just.
Right, I'm going to take a look at that tomorrow, and if there's something I can give out, at the very least, on our website, we have the first selectman's budget is public, and on the website, we could certainly, at a minimum, give you that, which is the base of it. But let me see what I'm sort of able to give out. I don't want to speak for a board that hasn't voted on any of these items, so, but let me see what I can provide.
And you took into account what we talked about last meeting, the base. I don't know how you're going to deal with that, but, I mean, it is what it is, the final number.
Right.
It's not going to change that, but it's just however you do a presentation.
Right.
We're still moving along here with the idea that we're going to do one public hearing
Yes,
The 10th.
on the 10th.
right.
And we'd
But-
skip the 16th?
The 16th is basically a placeholder right now, right?
Yes. We have to approve the budget,
And send it to,
well, if we approve it too soon, we change the referendum date.
Right,
right,
So we can approve it and hold it and submit it
that's right.
if we want to approve it after the public hearing. We can either decide to approve it that night or meet, special meeting to approve it, depending on what you hear.
Right, the action that triggers the referendum by charter is the actual filing of the budget by the finance director with the town clerk, ultimately. That, by charter, has to happen within 10 days of the vote of the Board of Finance. So you sort of have the power based on when you, one or two public hearings, as we talked about before, but also when you vote to approve it and also sort of thereby direct me to.
But if we voted on the 10th, you have to file it within 10 days by the 20th.
That's right.
And then if we did that, the referendum would be
Yeah.
the 6th?
Would be on the 6th, right. And the reason Thursday, the 17th, is a filing date, the town clerk's office has to be open to file it with them. That Friday is Good Friday and the office is closed. All of a sudden, 10 days, Sunday becomes 10 days. Obviously, they're not open then, so we can't file it on Monday, although it could be open to interpretation that you go to the next day after that, but it just really has to be.
So we have to have it approved by then, the 17th, and filed.
Unless you have another public hearing.
Right.
Right. But my recommendation, unless you felt the need for two public hearings, that you could have the public hearing, this is what we recommended, I think, 2 months ago, was have the one public hearing, and then you still have you could have a special meeting on the 16th, where your vote takes place, and you could have public audience and have another opportunity for more.
On capital, what happens on capital when they go to referendum, the capital, if it's over, what, 2%?
Right.
That's the magic number, 2%. So if the capital's under 2%, when we approve it, it's approved.
That's right.
So if we,
Individual projects, you're saying?
yes, we are the approval of that.
For any capital expense under 2%?
we have this date on there for the referendum at this point. That is not in line with this. This is our approved schedule, and I realize that we can probably have to stick with this, but we're going to have to change that.
Well, we just have to have special meetings.
Yeah.
Yeah. We have the
Rather than
13th.
regular scheduled
Yeah,
meeting.
okay.
And what we don't want to do is go later in May, because it causes problems getting the tax bills out if you go too late.
Particularly
You wanna-
if we have to have it.
Right. Because one year we had to go down, and we had to prove it that night if we ever wanted to get a tax bill out in time. So it was important that we keep our eye on the ball on when we have this. Right, we have some flexibility as to when we turn it in and what it does, but we just keep our eye on, so we're
Right.
gearing towards a public hearing for the 10th.
Right.
That's,
That's right.
now, when we move it along to the public hearing, we don't have to approve, but we can just move budgets along to the public hearing. We don't formally approve them till after the public hearing, but we can just move them along to it, not saying that we approve it. So that's usually what we do, or unless we have a strong objection, then we send it back.
Right.
And then say, because we know we're going to have a change, so we're going to give them a chance to work on it. So that's usually what we do.
Right. And you may recall the reason we talked about this a lot, and I think Nick was looking at this maybe too, was the original approved calendar by the Board of Finance wasn't in compliance with the charter in terms of that May 13th referendum couldn't happen because it would assume that you filed with the town clerk the same night as the vote. And that's the issue with the next day you actually have to file. So it sounds like sort of semantics, but technically, you have to be turning it into to the town clerk, which doesn't happen until the next day, which actually triggers a different referendum per the original calendar.
So I think if we go this schedule, everyone's happy.
This one
Carol, the
sticks.
town clerk's happy.
Town attorney's happy.
Got to keep everyone happy.
Everybody's
Attorney happy, town clerk, so we don't get ourselves in legal trouble here. I don't want to inappropriate budget, so
Neither do I.
I'm good with numbers. So just keep us on the.
All right.
Are the registrars, do they understand this schedule?
They do, and they're operating under this assumption as we are now. So they're, hiring staff and preparing the ballots and whatnot. I mean, some of those things are still flexible, and if
Well, I
if
know,
we need to, we can move it, but they are operating.
I know that Karen expressed concern about the timing of it because of just that issue of having to hire people and so forth.
Yeah, right. Knowing in advance definitely helps them staff the polling
And we're
location.
doing it in one place, one polling place?
Yes.
They use
Just
Terry
Henry
on that.
Jones.
That's typically what
think
we've
that's
done.
Henry,
Yeah.
yep.
And just the last piece, actually, you heard tonight from Vanessa, just a reminder, we were talking to Vanessa earlier about this, the auditor's contract is up, so for the FY14 budget, I believe the last one was a 3-year agreement, so you'll want to be discussing with the new finance director, I'm sure, about whether to retain their services again for the next audit, seek bids, how many years you'd want to, so those are some issues, just wanted to bring it up, and really just nothing to act on tonight, just something to think about.
And the last time we renewed it for a year, but we talked about going out to bid. We haven't gone out to bid in a while. So depends on the pleasure of the board. We can just put it out to bid, or if you have any comments, Joe?
Yeah, Vanessa's more than happy to honor the price for another year or a 3-year contract if you guys wanted. More than happy to work with her for a year. I'd actually prefer if you guys kept the same auditor. Reason being something new. Plus, in all honesty, guys, the price you guys are paying is fantastic. It's about $49,000. My audit, which was probably comparable, was $105. That was a distressed municipality. You guys have very favorable rates.
Who are you working with?
Cohen Resnick, they're real high price guys.
I've never heard of them.
Yeah.
Like some fly-by-night.
I guess I'm kind of torn because we sort of have a responsibility to the public to always make sure we're getting the best price, and going out to bid should be a requirement for everything we're doing. Having said that, I don't want to risk that they raise their price
Right.
because we're going out to bid. So this is a sticky one. If we really believe we've got a terrific rate, I don't know whether we can talk to them about keeping their price the same
Well,
way,
that's what
even
you
if we
just
go to
said.
bid.
Yeah.
Oh, no, they won't give that kind of caveat.
Well, why don't we just sit on it, think about it. Next week, we just either ask them or to do it or not, so everyone's just informed. If they're, make sure we're getting a fair price, whatever you feel we should do, all right?
So can we get some data on what a fair price is? So that's a really hard decision to not go out to bid if,
Yeah,
like what other towns are paying or is that data available?
it's got to be financially done. I can pull it.
Okay.
My concern would be, I would prefer bringing a new finance director in, not to make this change this year.
Exactly, that's what I was thinking.
Yeah,
The
I
value of
just- let's-
continuity, just,
Exactly.
it sounds like he's got some things to work on.
Particularly if he's switching firms and
Yeah, but still,
Well, we'll get the numbers.
if we can get some numbers, that would give us some,
Yeah, we've got one base comparison, which
Ne-
sounds like we're getting a great deal, but
Get some numbers in the next
Validate
financial
that.
director's report, the next meeting, and then we'll just make the decision, go or no go, So just be aware of, we have to make a decision. It's, only fair if we should do it now, if we're going to change, or give them the go-ahead.
it's fun to look at.
Anything else on our report? Is there anything else? Okay. All right. Next I have.
By the way, thank you, Sean.
Oh, yes,
Yeah,
thank
thank
you
you.
so
Yeah,
much.
for being active.
really.
He's not going to miss my phone calls, are you?
Ought to be a proclamation, really.
Why don't you call him about HR stuff?
Okay, now on reserve policy, I just put that on there because I knew we talked about it. We had the rating agency talk to us about it, so I think it would be prudent if we just maybe quickly got people's mind on what they think it should be, if they have any opinion. And I think we should try to adapt or adopt a policy, get a formal policy in the works. I'm not saying we can adopt it tonight, but just a couple people working on it with Joe maybe and some of the guidelines, and we come up with a policy. And usually what goes in a policy is a range of what we think it should be, and then what do you do if you're going to be under? What are you going to do to solve the problem? And then if you go over, what are you going to do with the excess? Usually you list where you want to spend the money. And you'll see we've been kind of doing what they recommend we do. You either pay cash for capital, you put it into unfunded obligations, you pay off debt, you solve other financial problems with it. But that's usually what's in there, so, people have any comments on that they think a range should be, and what I'd like to do is get two people willing to work with Joe just to kind of go through it. That's the main thing I'd like to have.
I'd be happy to.
If Jeff wants to be one, does anyone else want to?
Yeah,
Easy going.
I'd be happy to work with you on it.
Does that sound reasonable?
Can I ask, we've always focused on this one, debt service as a % of operating expenses. The other one he showed us today is debt service as a % of full value. Is there a reason that we've not historically as a town looked at that one too?
Well, he said they had like 30 factors though, and he was only showing us some, so.
Well, full value is a little, I guess the reason we've stayed away from it's a little harder to measure.
Yeah.
More
Well,
judgmental.
it's the equalized grand list that's published by OPM.
Well, fine, nobody's.
Right? Oh, I thought that's what I heard him say.
Yeah. But when is it published by?
Yeah, it lags.
How often do they
Yeah.
do it?
Right, so I think there's a
They do it every
lag
year.
and things like that would
They do
make
it
it a little
every
harder. The other is, we can see it, easier to manage, and there's nothing wrong with changing. Or use it as a guideline, there's nothing wrong with taking a temperature, using it every few years. I think we ought to be working on a whole host of matrix to just make us feel comfortable as to why we do what we do and where do we fall in this array of matrix.
Let's get the template that Bill
Yep.
said that he would provide us
Mhm.
as a starting point. And, I hate recreating
Right.
wheels if we don't have to.
I mean, I kind of lifted one from one of our clients, it's the same template, they use the same guideline from GFOA.
Yeah.
So you get that and you just fill in, that's what they use. So it's, you can see it, there's a few decision points. We have to think about the range, so why don't we let the group come up, get a recommendation, and then we talk about it and adopt it at a time, all right?
Can we weigh in, though? I mean,
Yeah, you wanna weigh in?
Do
Yeah,
that. I thought it was helpful to listen to the fellow who was here, who seemed to say very clearly that 10% was fine. And, I mean, I think that's sort of where we've hovered, a little above, a little below over the years, and that strikes me as a pretty reasonable goal. And he even ventured to say that going a little below it isn't going to affect your rating in and of itself. Obviously, it's a composite score. But I really like the idea of having a policy that says what you're going to do if you're under and what you're going to do with the excess money if you're over. I think that's, to me, probably even more important than picking the number.
Well, it gives you a guideline, here's what we
Yeah.
want to do.
Yeah.
And here's
Then
why,
you got a plan.
if we're going to go over, the
Yeah.
taxpayers can see our plan, and here's our plan.
Right. And I guess, a related topic for me is recognizing that, and we've talked about this before, that the investment returns that we get on these reserve dollars is extraordinarily low. I mean, like shockingly low to me. We got 0.25% or something horrible like that last year on millions of dollars that are sitting there doing not much more than sticking them under our collective mattresses. And so, I mean, I do feel strongly, while it's important to have the reserves for rainy day purposes and for purposes of keeping our rating at a good AAA, on the flip side, I don't want to take money out of people's pockets where they could be earning 10 or 5 or 10 or 15% interest on it, and we're taking it away and we're earning next to zero on it. I mean, we're hurting our collective prosperity in the town by doing that. So I think we have to strike that balance by not over-reserving, but being careful to make sure we have a good cushion.
Well, the reason we reserves is when we had the storm, As you know, you can see our cash, we were out about $4 million.
Right. But we got most of it paid back.
I understand, but we were out $4 million.
Yeah.
And we had the money to be
We
out
had it.
$4 million.
Yeah.
So that's why you have reserves.
Yeah.
Also, we've had heart and hypertension claims.
Yeah.
Where somebody asked for a $500,000 in settlement out of the blue,
Yeah.
and we get those. So there is, that's why they come up with those ranges. You never know. I've seen a lot in the years I've been on here. I know Nick and I have seen a lot of people with their hand in your pocket, so to speak, and that's why it's good to have the reserve, gives us financial flexibility.
Yeah,
So,
I guess
but I don't
what-
think we should over-reserve.
Yeah.
And to your point, very good point. So maybe Joe can come up with some, look at the investments and kind of work on that too.
And one question I would have, and I'm sure we don't have an exact answer, but looking back historically, when we've had to draw on those reserves, like, the biggest crisis we've had in my memory is the Snowmageddon thing, that still didn't take us down to zero in our reserves. We still had cash in there. So, we need to have a historical perspective of, well, what's a reasonable amount to have on hand? And if we have way more than we need, then, we need to not do that.
All
Let
right.
people keep their money.
Any other comments?
I've made the observation before that Granby to the north of us, they have a credit line with a bank to also augment their financial flexibility. There's no reason we couldn't do that.
I don't think so. I'll check on that.
Well,
I don't think they're allowed.
Joe, one of the things they're doing is instead of bonding small projects, they're going to a bank and borrowing it.
Revolving bands?
Yep.
Yeah, that's a little.
Yeah, basically, it's a revolving credit line.
What we've done is we've paid, but that's what we can pay cash
I
for
understand.
instead of using a debt line. That's why we should think about maybe using some reserves. That's why I like to keep my eye on the ball on what reserves are.
Yeah.
Because when the capital plan comes in, we can pay cash for some of these, not bond them.
Right.
I like that
that's-
idea, because if we're looking at 2-3%, we're earning 0.25%,
Yeah.
makes no sense.
Right, exactly.
So, but
Can
also
we-
he says we have to show the ability to add to reserves, so
Yeah.
we have a delicate balance there, but there's many ways, that's why we get the capital, we can do some creative things there to,
So being one of the people that volunteered to work on the policy, I think we're way expanding the scope of the policy.
well, just
We're
get the
really-
policy.
Yeah, okay.
Yeah, just get the
Okay, just let's
policy.
make sure this discussion
Just get the
isn't-
policy, we'll get a range, and
got
then, right.
Okay, I was about to ask to expand the scope more.
Then you want to serve on the committee.
Linda, we're just trying to get a policy,
No.
we're gonna start
Yeah, no.
something, and then we can eventually expand it.
Yeah,
I just wanna get a
and that's
policy.
fine. I just want to.
We don't have a policy, I just wanna get one.
To Joe, if, just to weigh in on that topic of, is there a way to get better interest, investment earnings on, because that will certainly factor into my comfort level.
You think we are?
You're very limited from an investment perspective.
Right, I know that.
You guys can invest in T-bills, government-backed securities, and CDs.
A-rated.
Most of the yields right now are maxing out at 1% per year. But you do have an opportunity cost if you guys look at your OPEB. There's no reason you can't appropriate money into your OPEB or your pensions where your rate of return is forecasted at 7%.
That's what we did last year.
Can you borrow back out of that?
Yes. Yes.
Borrow it back?
On the OPEB, you can. On the OPEB, you can build down the money and pay for retiree medical expenses. Now, so you're kind of limiting yourself a little bit, but you can do it if you wanted to.
So that's, but I won't expand your, I promise.
Okay. All right, so we got the group? Okay, good. Collection rate. Do you want to, one of the things we're talking about is changing the collection rate. We've had historically 98%. Do you want to put up a slide to see what things look like, what it would be, or do people have any feelings on the collection rate? Or you think a guideline, we don't have to absolutely decide tonight, but one thing we have to do is for the public hearing, we should have a number that approximately what we're going to use up there, and then we finally set it when we set the mill rate. So that will be in May, but, if we're thinking of raising it, we should probably talk about that and a range of what people feel comfortable with.
Raising it or lowering it?
Raising it to Well,
Right now,
we've
we
talked
have
about
98%.
98.5.
Oh,
Raising the collection rate, so if you go, let's say.
We're
to
talking
90
about for planning purposes
Yeah,
here.
yeah, plan.
And quite frankly, since it's for that purpose, I would think that we would want to have as much flexibility in what we set the rate at year by year. I would be opposed to having a policy that says it has to be a specific rate. I just don't think it's
But it's-
Yeah, I
necessary.
don't think we were talking
Peter's
about
asking
policy.
about for this year.
This year.
I don't care, any year.
No, but for this year, we have to,
But for
at
this
some point,
year-
set
At
that.
some point, we will, going through our mill rate planning process, we will use a rate, but I just don't want to be locked into it.
I guess I'd feel more comfortable having the Board of Selectmen budget in front of us first, because there may be some needs that need to be accommodated this year that would necessitate our increase, and I mean, I agree with you, though, we can then exercise that discretion.
Well, I think we indicated when we were talking with the Board of Ed that we were willing to entertain going to 98.5. So I think
That's
we've gotten
correct.
a sense
That's
Yeah.
correct.
from
We wanna put
everybody
up-
already.
You want to put up the slide there, or what? Yeah.
So, as you guys look at this, there's something to keep in mind. You're seeing a grand list growth of about 0.9% on this. Now, when you talk about grand list, you guys do understand that it changes on a month-by-month basis. So you had, January of 2013, you had a grand list that had a number. You guys actually budgeted a number that was based on an April timeframe. It had a lot of reductions in it. So that's why you might have heard the assessor state earlier that the grand list growth was 0.6. No, it's 0.9.
Wow, so what does that give us for that?
Well, that's-
Is there a
Very
reserve in there
helpful.
for any possible
There
grant?
is. So if you go to the grand list components too. So 1.5, there's absolutely zero backup for that. I've never done a reserve. It looks like last year you guys had estimated additional changes of 1.4. I truly just picked 1.5 as a WAG.
I'm sorry, I don't know what you're talking about, and I can barely.
Sorry. So this is a year-on-year comparison. So you have the 2012 grand list values, right? It's 2012, 2013. Right? This is the changes. This is the 0.6 that I was talking about earlier. What you do, or the math that you guys work, is essentially you reduce your grand list value by your elderly home owner state program. This is consistent with what you've done in the past. It's consistent with other municipalities have done. All right, last year, you guys had a reserve of 1.4 million, and then you had changes that occurred between January and May. These are typically Board of Assessment Appeal changes that kind of go into the grand list. You guys chose to update it in May. So this was the grand list, sorry, this number should be gone. This was the grand list value that you guys planned last year. This is what I'm coming up with this year. And
What is
this-
that, 2.23?
2.229, sorry.
9? Okay.
The estimated changes was what I didn't understand. You're assuming that.
There is absolutely no backup to that, correct. I would
To decline?
It's
Your
judgment of the
grand
assessor.
list from now until May should go down, but the question is how much?
Because of
Most-
appeals.
Most of your Board of Assessment appeals happen in the year directly after you go through the reevaluation, so the abundance of that should have been last year. Having said that, there's probably some remnants that are out there. There's probably people that are
So
getting
that's a
late to file.
conservative estimate.
Correct.
So historically, we budget, the assessor gives us a number and says, I think it should be lower by this.
That triggers this
The
number
judge-
here in the yellow, right? That's ultimately the next grand list that goes here, which helps. So,
So that's with the reserve, we're up about 20 million.
and these numbers in green here are the budgets, including the Board of Selectmen budget, which you'll be getting on Tuesday night. Change as is its last iteration, that's the number there.
And that's
Sorry,
at
at the moment, our best
2.3?
guess. 2.20,
2.20.
That's the unadjusted,
unadjusted for the
so the raises.
205,000 we talked about last week. But that's the year over year, right, compared to what we budgeted in 14.
And you've done no change to the debt. I mean, that's the number that will come through if we don't add anything.
Correct.
As long as you don't bond.
Okay, and you got 105 in on the Board of Ed. 44 point, okay. What are you doing on the indirect revenues here?
Small increase.
Small increase.
Well, they've already, the Board of Ed's already got 54,000 that they're, just that one change would add, I think, 69 basis points.
So I've been going through these are, this is a lot more information, which you'll be getting on Tuesday, but what we've been going through every item, these are all the revenue items that populate that number.
Yes, I know it's
Some
a
are
lot.
up, some are down. Obviously, there's
Telephone access grant, for example,
Yeah,
we lowered
it's
it
all
by
over it.
7,000. We have numbers from the state. There's even questions whether or not that's 7,000 too high because there's potential one of the grants has ended.
So the result of all of that produces
all of
the
that
seven,
comes up with what ends up being your indirect revenue number.
and that was what, 7
7, 8.
basis points?
$7.8 million.
0.07.
0.07, yeah.
So when will we actually get this information to look at before the Tuesday meeting?
Okay, what information?
Well, so we.
There's
Lots of
You're
information,
not
Barbara,
gonna
it's
see-
a constant
we're-
moving target.
We're
I
not-
know,
We're not going
but-
to look at this until later, but if you go plug in 98.5 in the collection right there, and this,
Yeah,
Work-
that's
this
the-
worksheet just looks at the town piece of it. It doesn't have the fire district in it, right?
Right.
Right.
With all of those things in there, we're about flat is the
Yeah.
We're down a little
point.
bit.
Yeah.
With 98.5, we're down slightly.
Well, to me, it's basically flat.
What's down 0.2%? It's not up. It's not zero. It's
Well, the
not.
fire district's what, 1.2?
Sean, if the town comes in at 1.98, that's netting out, that's making the other adjustments that they're looking at considering doing? That would reduce it a little bit more, right?
Gene, help try and
Do you
figure out
want
the
me to pull
math.
that number? I have it actually.
I don't know that we're going to get really very far by spending a lot of time on this.
Yeah, just for people's information, 98, the question is, anyone have a problem if we go to 98.5? We've been at 98 for a long time. Looking historically, if you look back the last 10 years, the lowest we've gone is 99.2 something. Now, this year was starting to look a little negative, but it turned back to doing okay. We have to have the ability to add something to reserves. Question is now our reserves are, unless people feel our reserves are inadequate and we want to build them up quicker. For a while there, they were inadequate and we tried to build them up. Now we might not have to do that. So it's worth looking at it. I've always been not for changing the collection rate, but after studying it and listening to people, 98.5, I don't think it would hurt us,
Yep.
in my opinion. I think 99 would be a bit aggressive and we'd be taking some risk because there's some,
Got nowhere to go.
you put yourself against the wall and it can only go the wrong way. So it doesn't give us much financial flexibility. So
What is the
It's
fire
almost,
district one
it
point?
almost flows
0.2, isn't
straight
it?
through the half a point.
Have they concluded yet for the year?
no, I haven't heard
Oh, you're
anything. I don't know
They've
if they
stayed
are.
Board of
flat
Selectmen?
for a long, long time.
They have a point on the grand list.
Would be nice
and
if
then
they
the mill rate
came
is
in
It's almost one
negative.
I've never seen them go really much
So-
better than one.
Once we get the Board of Selectmen and we know, and we start looking at the capital, how we're gonna figure it in, next Tuesday, we can get a better idea, but just in people's mind. Numbers are changing, they got better on the grand list. The indirect is now done, because there's a lot of items, they did a lot of work. So we got a solid number, I was kinda hoping it would go up, but it didn't. So there's some items that we over budgeted, now we got it better budgeted. So there's some opportunities to make more money, but it's probably a good number. So, there's pieces that are slowly coming together, and as it comes together, we work down to, the ultimate goal of setting the mill rate, which will happen in May.
It's almost $1 million.
But we have to go before the voters
917.
when we do the public hearing and tell them a range of what we're thinking, and right now, I'm thinking going for the voters with 98.5, I'd probably use, unless I hear otherwise, when we talk about it next meeting. So next meeting, you'll have to give me the direction of what you think would be a good number to go.
So, let me just do my rationale.
Yep.
we often use our 900,000, which the only reason we have it to take out is because we had a collection rate a little bit higher that gave us a little wiggle room that during the year, when these things came up and we just had the 550 that we don't have this year's. So if we use our 900 and we're at 98.5 to 99.5 is what we really collect, right? So you've got a point there. That point, we were just doing this, is worth about that 900.
Correct.
So what we're saying is, if you were to go to that half a point, you are definitely not planning to not build reserves and planning to, and giving yourself the room to do the 900 and nothing else.
But you don't need to grow reserves ad infinitum. I mean, you're already
Agreed.
have an ample amount in there, so.
I was just trying
Yeah.
to walk through how I'm thinking about.
We just have to be
the
careful when
adequacy.
we budget that we don't make any whoopses.
Exactly.
And we don't need the 900 because it might not be there.
Right.
So I don't think we've
Well-
really had to tap the 900, the full 1%.
Well, we also haven't asked Sean and Burke how much money they're going to turn back to the general fund this year.
And I'd also
Well,
point
haven't
out
they
that.
both told us they're not?
I think they told us the number is 0.
I think we heard that already loud and clear.
But also
I
the
wanna push 'em a
collection
little
rate.
bit.
I think the 99.5 collection rate, if I'm remembering, and Sean, you can correct me, but my recollection in looking at the CAFR, which I don't have, is that 99.5 is typical, or 99.6 in the year, but over time, you end up collecting almost 100% in most years.
Yeah.
So there actually is more cushion than you're suggesting. Do you-
But we
do you
budget for that
follow what I'm
collection though,
saying?
too.
Yeah, because we're still collecting taxes from 4, 5, 6.
Right, but she's saying that we
Right,
would
there's a
only
cost
have
of
that one
collecting that,
percentage
so-
point, so.
But we budget for
Those
it.
are planned,
Yeah,
Those are
but,
planned.
but
Right.
they're small
not
and they stay pretty constant.
I'm very comfortable. Looking at the mill rate comparison, I don't know what other towns are going to do this year, but kind of hoping that West Hartford will go up. They're at 36.3 right now. We're at 38.51. But I think whatever we can do to kind of hold the line will be really helpful. And also, while we're marketing the Hartford property, I think it'd be very useful to show that we're holding steady and that we have that
Yep.
that mindset right now.
All right. So just keep it on people's minds. This is where we're moving. We have to, this is going to be change for the board and good change for the taxpayers. But I think we're not going to make any mistakes, or at least we got more financial flexibility. We're not going to jeopardize our rating or anything like that. I didn't hear anything from the person there. That's what I wanted to hear, to see if we're going to put ourselves in trouble by doing that. So I didn't hear that. Now, I put on the next one, planning for the Hartford, and what I think we have to eventually do is, if something happens to the Hartford, and
When, not if.
if something eventually happens to the Hartford, I'm an optimist, what could be the worst-case scenario financially for the town, and what are we planning on doing that? We, our board, do we want to have a plan in advance for that? So I think we ought to think about that and actually get a plan. Because I figure out the earliest it could happen is for budget year 16, 17, we might have the reality of having to go into action with a plan. So I would love us to get a plan for what's the most we could get hurt. And I looked at property, real estate, personal property, and land. And then, are we willing to designate a piece of reserves for this solution? Or how are we going to do it? I've thought about a 3-year phase into the taxpayers of the loss, if there's a loss with the use of reserves. So there's many ways to approach this, but our board should come up with something.
We want to quantify, I guess, what the potential impact could be, because the land will still be there and will be taxed, and the building presumably will be there beyond at least 16, 17.
It depends, the value of the land, Jeff, depends a lot on whether there's a building there or not. And what the land is used for.
Well, yeah, but it's zoned for certain, the value is, the taxes paid is based on how it's zoned,
That's
isn't
what's
it?
there now, but that doesn't necessarily have to stay that
I
way.
think they're looking at, I could be wrong, but I thought I heard they were looking at making the zoning more flexible so that like any possible
That's
thing that
correct.
came along could just zip right through. So I don't think zoning is
Any possible thing.
Well, from our standpoint, what I'd like us to do is just,
anything that we liked. that
from the
came along.
financial standpoint, have a financial plan, assuming a worst-case scenario, so we're ready in case the rating agencies say, gee, you guys are going to lose your largest taxpayer, what are you going to do about it? Well, here's what we're going to do financially. We have adequate reserves. We're going to phase it in over a 3-year period. We're going to ask the taxpayers to maybe shoulder some of the burden, and we're going to ask the other two boards to take cuts, if that's what we so choose.
Right, I guess we also want to look at what's coming online, so I think we're looking at, what,
Growth.
$1,600,000 total right now, and so I guess what would the worst-case scenario be if it was just the land, but then I guess I'd like to look at what's coming on.
But what I'd like to do is maybe we start focusing on it, a couple of people look at scenarios and kind of present us with a plan. I know, I wrote one down one lunch, and I have a plan, but that's just my plan. I think we should get our own plan, and everyone should agree on what looks reasonable. But I think we should be prepared.
We heard on the Big Y construction schedule or anything, because I guess we could do evaluation too on that based on the average cost for that kind of building. I mean, I don't know, maybe it'll be 250, 300,000 possibly in additional tax revenue.
That's just one of a number of things.
There are other things coming on, so our tax base may be able to.
We can talk to the building department, because I heard some number about what's about to come on, and that's the kind of information you want to get, and then assume you got a grand list growth of X, going to happen over the next 3 years, so we just, people can say, well, gee, what's your plan? We have a plan. I just think it would be prudent to have a plan, worst case scenario, in case it happens, we're ready.
Yep.
I think we have adequate reserves, maybe we want to designate some reserves, so I suggest a couple of people work with the finance director in the next couple of months, and we come up with a plan, so we can look the voters in the eye and the taxpayers and say, we're working on a plan for the Hartford, and we feel we can handle it, and it should be a reasonable plan that won't put a burden on anyone.
I like that idea.
So I think that's a great idea. My only concern is, we also had the conversation around actually doing a long-range plan, looking at capital needs, where the Board of Ed and the Board of Selectmen and Board of Finance all working together. There's a fine line where this analysis ends and that would start, because that would be looking at all kinds of assumptions. And if we start to bring in the growth that we know about, there's also other potential downsides if you're looking at that longer term on, school enrollment declines, that bigger picture of a 3-year term.
What I'd like to do is we get that group set up after the budget season with a charge of what our board wants to see them accomplish. Some of the items, we get an action list we want them to address when they do the long-range plan. I think that would be good on our board. And then we get a couple members, we organize that. I don't envision, this could be one little piece of it, but I envision this is kind of like its own little world, so to speak. That just shows, because we might go to bond in January, and I think we need to have something ready to show our rating agency that we're on top of this. That's just what my financial instincts tell me. I think it would be prudent, so.
Agree.
So if we can start working on it, just a couple of people want to do it. If they want to volunteer now or tell me later, we'll come up with a group and ratify it, and then we'll start working with Joe on this. So think about it. Next meeting, be ready to volunteer?
I'm conflicted out.
Okay.
Wife looks.
There we go. Easy. All right, budget, we kind of talked about. I don't know if we have to do any action on the budget, just, we kind of put that on there in case somebody, we have the Board of Ed budget discussion, and, we had that last time. There's, we kind of saw the slide on the collection rate, so on our budget, that's kind of what that was all about. Board of Ed budget discussion, if, we all commented on what we saw, where we heard last time, does anyone have any strong objections to their budget, so we should say, gee, you guys got to revisit this, or we're going to probably move it on to public hearing. We don't have to decide right now, but, move it on to public hearing, subject to public hearing, then we'll decide if we want to adopt it or not. It doesn't mean we can't change it after public hearing. So it's just to keep it in your mind. If I don't hear strong objections, we'll just keep going along and assume we're going to move to public hearing.
That's
think
fine.
things are looking good.
Yeah, so just want to give everyone the opportunity to comment. Goal setting. Now, we had the goal setting out. We don't have to do it tonight, but we should, we kind of have them organized. maybe we should ratify those in the next meeting or two, what we think are important. I mean, I got an idea from there, they're pretty common, I think I hear the themes in what we're trying to do here. We're doing some of the themes in our goals, so I think we're kind of following them. And, but I want to try to articulate those when we do that public hearing, and I'll tell you what I was thinking of articulating when I do it, so you can get your opinion as to whether these goals represent our board, the ones we set. So I just wanted to keep that on your mind, too.
I think it
And
might be good to resend them to everyone, because
so why don't we send those out?
email from you
And Joe, we
before,
can send
but I
those
don't
out, the
think
goals
official.
that Barb and Linda did,
Yeah.
organized
But I don't think
them.
they officially went out. I think
Okay.
they just came from Barb.
They actually got attached to the minutes.
They're in the minutes.
They're like 6 pages
They're in the
long,
minutes.
right?
Yeah, they're long, so we should, why don't we resend them out, so we'll just,
Got them here,
yeah.
yeah.
Okay. All right, picture next meeting, 3:25. SCTV, I have to go on with the superintendent and the first selectman on the 28th of March, so be prepared. I'm going to tell you what I'm thinking about, going to talk about. So next meeting, I'd like your thoughts on what you want me to talk about the budget process. And, it's not finalized where we are, we're still going to, what we've seen presented to us. What we're thinking about with collection rate, I'd probably talk about things like that, and some of our goals I might want to talk about to the voters, and, just to give them some information on what's on our mind and what's going through in the budget process, dates and senior tax relief, we usually talk about things like that. So appreciate all comments and thoughts on it, to keep that in mind. And anyone have anything else?
Can I bring up,
Yeah.
we're holding another
Yeah.
group waiting, again, 15 minutes tonight. Is there a chance we can start earlier? Because this seems to be a pattern that we're disturbing another board.
Or,
No.
No, I'm just,
Well, we'll look into it.
I don't know, it's pretty tough for us who aren't retired.
Sometimes it's hard to, for people to get here. Yeah, I mean, we got to be respectful of people getting here.
Once the
so.
budget season's
do
over, this
5:30.
will get better. I mean, in
Yeah.
another month.
Yeah, it'll be
in another
easier
month,
after
we'll
this.
be- Yeah, we'll be past this long-winded thing, right?
Unfortunately, we have to
I
go
don't
through the
know.
budget processes. And we're going through some other things that we normally wouldn't go through, but it's good for everyone to get a understanding, a base of what we have to think about. So I think it's valuable.
motion to adjourn? They're waiting.
Okay,
Second.
second. All those in favor? Aye. So moved. Thank you.
Joe? This is
Throw
the
down.
summary sheet of my work using the mill rate sheet. There is an additional worksheet